when we are looking at CPI, the main goal of CPI is to understand what the Federal Reserve is ultimately going to choose to do with monetary policy. Why do some of these events mean anything at all to us? Basically, what they mean is that as the Federal Reserve, let's presume they already know what this is, but as we get the CPI data, and why are there so many? There's a month-over-month CPI, so what is that inflation metric doing on a 4-week sort of rolling moving average? What is it doing over the last 12 months? Both of those matter. So month-over-month, year-over-year. And then we have this kooky thing called core. Why they choose to do this is because food and energy tend to be very volatile. Who needs food and energy, right? I mean, who needs to measure the inflation of that? No one needs that. So just to sort of highlight a little bit of the ridiculousness of it, and yet, while it may not be real, while it may be a funny calculation, it is ultimately important, and we're reacting to the data. Or I'm not judging it, well, maybe a little. But at the end of the day, the whole point is to understand what it means to the Fed, not what it means to me, excuse me, and we can at the same time look at what it means to the indices, treasuries, currencies. So we'll be paying particular attention to what the euro does via the 6E. Let's jump on over there. All right, we'll be paying particular attention to what the euro does because that's the best way to look at the US dollar in an environment where we are preparing for a central bank, any central bank, to cut rates. The currency of that country, the stock of that country, should be weaker. The way we measure that is with the euro strength. Euro strength means US dollar weakness. It's just that simple, and it's the best way to look at it. Yes, better than the dollar index futures themselves, better than the UUP, better than the DXY, because those are baskets. Those are baskets of currency. This is the most direct view of the dollar. All right, the next thing is, hey, what do bond traders have to say? Bonds are a massive market, right? And bond traders are looking anywhere from 3 to 6 months ahead. And the whole point of looking at bonds is to ask ourselves, all right, well, what do they think about rates? If rates are going lower, in other words, in this case, measured by bond yields, this chart should be going up. Same thing with the 10-year. So this is how we measure this. And of course, we have the S&P and the NASDAQ, and that's the focus of our trades. So if I'm looking at what it is I want to do, the focus is futures, right? We are trading futures only. It's 8:18 in the morning Eastern. We're looking at the S&P. We're looking at the NASDAQ. Remember, things are going to happen fast. This is huge volatility. So things are going to be happening very quickly. There's a lot of risk that we can look at, choosing to engage in or not. And micros, of course, are available in each of those via the MES and the MNQ. Right? So that's the focus. That's the why. And at the end of the day, it's a trading opportunity, right? It's simply a trading opportunity. So how do we set this up? I do this with hourly price movement ranges. Now that's going to be my zone of entry. But which do I choose? Right? So I'm using the historical price movement range. What tends to happen between 8 and 9 a.m. on a morning like this? So rather than looking at, and I'm just for a moment just going to contrast ATR, because I get that question. Rock, why this hourly price movement range thing? Why not average true range or any other metric to measure volatility? There is no other metric to measure historical volatility than an hourly price movement range that I know of. If there is, I'm completely unaware. The idea, though, and I've looked at thousands and thousands of indicators. There are a lot of things out there that can measure volatility, but none will do so with a historical multi-month look back. And that's what we've got here. What not to trade? I would not trade gold during this event. I would not trade the 10-year. I would not trade the long bond. It's S&P and NAS only, and then hourly price movement ranges. But are we focused mostly on being buyers or sellers? In other words, do I want to be parking buy limits or sell limits? That brings up the next thing. This is not actually, never am I looking at market orders. Market orders are the gateway drug to overtrading, getting in now, getting out now without any real specificity around price. So this is all going to be about how do we take advantage of limit orders, price conditional orders, and I park them, which is to say I figure out before, ideally about 8:28. So I want to have my orders in by obviously before the event comes out. That's really important because these hourly price movement ranges by design will move when we get the extreme data. I don't want to make decisions after. I want to have the decision about where I want to be a buyer or seller before. Now on the ES, you can see right now, the ES is just below the previous session close, the PSC. That's the 4 p.m. cash close. So we're just below that. So that's a smidge bearish, but here's a problem. This orange line that cuts through the middle of this zone, so here's my hourly price movement range, red zone, that's resistance. Here's the hourly price movement range, green zone, that's support, right? And the fact that it's sitting in the middle, this is not super clear as to whether or not I've got really a bearish sentiment to start off this morning as we go into CPI or bullish. So I'm going to have to bracket, right? I'm going to have to bracket this, which is to say I'll have to be open to the long or short side. Now, right away, I don't like that. As a general rule, I want to have a lot more clarity below the previous session close. And that is what I have on the NQ. So ES is barely below. NQ is firmly, much more clearly below the previous session close. All right, the next thing I'm going to do is figure out which one of these I would prefer to trade. And it's, well, no, I can't say it's even firmly. So no, I take that back. It's just below the previous session close. Because when I kind of zoom out, so make sure we zoom out. All right, so when I zoom out, no, I'm going to have to bracket. So bracket means I will place both a limit order to buy and a limit order to sell. So you might say, Rog, how does that work? Now, first of all, let me mention, this is less than ideal when I have this kind of move. When I have this kind of movement, I want to see usually a lot more clarity on the sentiment. Sentiment is that previous session close. By the way, that's the broadest view. Most traders, most investors are going to look at their portfolio and say, I'm up or down based on where it closed yesterday. And we had a really strong close yesterday. And that tells me that, you know, going into this morning, traders were willing to be long as the market closed. That tells me something. All right, so I'm going to have to bracket this. So one, whichever gets hit first, the first limit order to get hit is my entry. The second we can leave out there, and the other limit order, untouched, becomes a second target, second scale out, second profit target. Now, what about the first? All right, let's get the numbers crunched here. Let's go on back to this zone here. And so this is the most time-consuming part, if at all. So NQ has a range at the most aggressive on the short side of 18,467, call it in 3/4. The middle of that zone's right there around 18,500, major psychological level. And then at the very upper edge, I have 18,533. Now this is my red zone. The red zone is my limit order to sell. On the NQ to the downside, the green zone starts, as you can see here, at about 18,339.25. The middle of that range is right around 18,308. Notice I'm not getting out my protractor and getting really, really specific, but just the upper, the center, that middle, and the bottom edge, 18,274.25. Those are where I will park the limit order to buy. And again, if you're asking yourself, Rog, what's a really great filter to say nah to an event like this? It's kind of what we have right now, which is just not a lot of clarity around the previous session close. We're up, we're down, not a lot of clarity at all. And the idea here is if we can spike in one direction, that it could be exhaustive because of sort of the extreme opinion of that initial reaction to the headline number. Headline number, again, is 3 of them, month over month, year over year, and that core. All right, on the ES side, my limit order to sell starts, as you can see there, at 52.83.5. The center is 52.92, and the upper is 52, Well, it's actually 5,300. Okay, and those again would be my limit order to sell. On the downside, all right, what do I have? I have 52, 54. Now you don't want to take these too far ahead of time because they will adjust a little bit if we put in a new high or new low. And that's why we kind of have to do that, not last minute, but sort of last minute. 52.38.5 is my bottom level. So upper edge, that's center, and then the lower edge. And those, of course, will be my limit orders to buy. All right, the center is pretty much the PSC. So the first target on either, this just happens to be the way it is today. Otherwise, I'm looking for the middle of the range. And the first target on both is going to be that previous session close. So on the NQ and on the ES. So NQ is, actually, we'll start with the ES, 52.70. What is that? 52.69. And on the NQ, $18,410.5. That's it, gang. Now, if you've never done this before, this would not be the ideal day to start. First time you're learning something. This is even, again, less than ideal in terms of the setup because of lack of clarity around the previous session close. If I'm below it, I'm a little bit more a fan of the short, even though we'd have to go up above that level. Now look how far it has to travel to even get there. It may not even touch it. It could touch it very quickly with a wick. Doesn't mean it's going to get there. Okay, doesn't mean it's going to get there. We just have these out there, and of course, no trigger, no trade. So at this point, so no trigger, no reaching that limit order. And this is the way we do all of our trading, right? So there's really not a lot of directional bias here, gang, which makes it less than desirable. So no clear directional bias. No clear DB makes this not as ideal a setup. Okay, so now I'm going to go ahead and make sure everything's in right because typos are a thing. Want to make sure those limit orders are correctly. And all right, there we go. Okay, so that's it. Now I wait. Now I wait. Now you can turn on the television, whatever you want to look at the number, whatever you'd like, whatever is most comfortable. You can, this is where, say, turning on financial media, television is fine. They'll give you the number. They'll even give you a little bit of a take on it. And that will largely be reflected in the price action. So at this point, I don't care what the number is. I'm looking at simply the reaction to one level or the other. All right, so is my NQ, yeah, I might have had a typo in that NQ. So 18,467. This is why I checked the 18.5 and 18.533. There we go. That's why we check them. All right, so there we go. That's what I'm looking at. Now, waiting for the moderate, the middle, or conservative is oftentimes ideal because the stop is on the other side of the range. Now notice how everything adjusted. Notice how everything moved, right? Here's the data coming out. Notice how everything moved. Now moderate or conservative is a lot of times a really good place to park your, and you can just go with conservative only if you'd like. Now moderate or conservative is a great place to place these orders because a stop loss is on the other side of the conservative or that more extreme read. All right. So like I said, today is not my favorite in terms of levels. On NQ, you can see if you place your moderate and your conservative with a high up here of what, 37, that got hit. So moderate and conservative. So if you're waiting for a conservative, no problem. You got that conservative fill. We'll talk about the stop in a moment. One of the things that's really helpful to do is when we get the data, you can do what we call a 2-minute switch. By the way, here's your move on the ES. Again, all the orders, whatever I'm willing to put skin in the game at, right, is placed. So even that 5,300 easily tagged. Now we want to see, after that initial move higher, we want to see price action come back down. Now, yesterday's surge obviously told us there was a lot of bullishness. And in some ways, even though we were below the previous session close, like I said, either one would have been fine for the fill. This just happens to be where we got filled first, right? So you might say, how do we adjust to a no ideal setup in terms of directional bias? Again, you can focus on that moderate or conservative, so you can scale in at both levels. That's it. Now I wait. Now, if I go ahead and do that 2-minute switch, let me show you here. So I'm going to jump over and grab a 2-minute chart. There we go. Not 3, 2. And there's nothing for me to do now other than to sort out where I'm willing to take this trade to, right? That's it. Come on. Sliding. There we go. Okay. So when I look at this 2-minute chart now, what I want to see is, think of it this way. The 2-minute chart cuts the 5-minute into 2.5 candles. The hourly price movement ranges are in the same spot. The multi-structure will look different, right? And notice we were looking on the 5-minute chart at a neutral environment. The multi-structure will tell me it's gray, but the 5-minute read on both my secret squiggle and the multi-structure, neither of which really are super in play for this. I'm really looking at the hourly price movement ranges. But what I can look at is something as tight as the initial reaction high. So when I take a look at the ES, this is a stop loss placement consideration. I can look at a minor high here, which would put my stop just above 53.03. So that would lead me to look at a stop loss just above. It could be 2 or 3 points, even maybe 3 points above, in this case, 5303, right? That's one way I could look at it. And again, remember, when we don't have a lot of clarity, as I mentioned before, go smaller size, choose the conservative. These are easy things to do. So I'm looking at maybe 5305, 5306 as a stop. All right, NQ. So I don't want to be sitting in an abnormally large amount of risk. The minor high based on the reaction high is a good place to look. We want to give it a little wiggle around that level. I'll give you all another support and resistance level to look at. And that would be what we call the hourly price movement range shadow, which is a huge amount of risk. I don't recommend that. I don't necessarily use that. I really like this minor high calculation that I'm walking you through here. And in the case of the NQ, and now look, 2 to 4 S&P points is $100 to $200 per contract per mini, right? So 2 to 3 NASDAQ points, they're not on par. So I'm thinking about just some typical wiggle in the S&P versus the NAS. With the NAS, it's going to be usually about 8 to 10 points. I'll give it about 8 to 10. Now, 8 to 10 NASDAQ points is going to give me about $160 to $200 of risk above that level. So if you say, Rog, I'd like to have my risk, no greater than X dollars, fine. That's absolutely within, if you want to say, Rog, once I get in, I can see where the minor high is, and I don't want to risk more than $50 or $100 beyond that. If you notice, my tolerance is about $200 per contract. All right, so in the case of the NAS, it's about 8 to 10 points, in this case, above this high, which now has a Darvis level, which is great. So that's 18,547.25. And that's it. That's it. So the idea here is that after an extreme move, the numbers are getting digested. Notice that not once do I know what the data is. I'm purely looking at price action. And I'll tell you, this is a high risk, high volatility event. And it doesn't matter how many times I put these trades on. If you are not getting a little bit of butterflies when you're putting on, just a little bit, when you're putting on a trade, you're not respecting the risk. Now, if you're feeling like you need to, lose your breakfast, you're putting on too much size, or this is not an event for you. Don't underestimate how you feel during a trade and what it reveals about your comfort level. Now, my comfort level is already low because of that lack of previous session close clarity. So I'm going to go really, really small size, and I'm going to favor that conservative. It's just that simple. So I know at this point, my risk is really muted. If I'm wrong, take the small loss. Don't put yourself in that unenviable position of, I can't get out now, I'm losing too much. So my risk is going to be from the conservative entry to, in the case of that minor high, 2 to 4 points above it on the ES and 8 to 10 points above it, that high, that minor high, which you can see now we have the minor high arrow there. And I believe both probably have the Darvis automatically drawn there too. So it's just another visual cue. And it's not snapping back as quickly as I'd like. Frankly, it is not. I would have liked to have seen a lot more weakness. You know, when we get that immediate reaction, I want to see a reaction back down to the downside pretty quickly. So ideally, my fills trigger within 3 minutes of the data release. So I'm not going to keep this trade out there. So if you're wondering, Rog, if it goes back up and tags, 5,300, do we get in again? No, right? We have 180 seconds because we want the immediacy, that sort of, we want to capitalize on that overreaction, not as the data. And look, all of these are reduced to a headline number, that number that we see on Forex Factory, that we see on television. I don't have my TV on. But as traders and investors have 5, 10, 15 minutes to kind of parse through the data, there'll be secondary reactions. Obviously, I'm positioned here for the reaction to the downside. Not liking the way it should have snapped back, what I'm going to do is I'm going to place an optional target, which gives me two choices. So these optionals that we use let me either scale out and or move to break even. And 52.94 is where I would like to do that right now on the ES. So I can scale out of a third or half of my contracts. I don't like the way it's not reacting immediately. I'll keep at least 2/3 or a half of my position still open. But what I want to do now is put in a break even stop, which means if I have that 50, the upper edge of that red zone, so 5,300, I might risk to 5,301, right? So that would be I know it's not exactly a break even, but that would be where I don't want to risk any more than about 5,301. On the NASDAQ, let's do the same thing. All right, so I don't like the way we're not snapping back. See, we're trying to cross down through 18.5 on the NAS, which is kind of nice. So let's do the same thing. I can move to break even and or scale out. We're moving down through 18.5. There's a really good chance we get to 18.480. So I'm going to do that right here at 18.480. Now, why would I do that? Because when we cross through a major psychological level like 18.5, it tends to move to 18,480. If we cross up through 18.5, we tend to go to 18,520. It's just an interesting way in which we have these major psychological levels, 18.5 and 18,550, right? And then we have these minor psychological levels at 18,520 and 18,580. And that's why as we broke 18.5, 18,480 is a great place to put that optional target, which again, I can scale out of a third or half of my position. But the key here, the main point of these optional targets, actually the main point of any initial target is to start your risk management process, okay? And of course, as I take a look at the chat room here, a lot of you say, Rog, I'm doing the micros. Great, fantastic, perfectly fine. Some of you will say, hey, Rog, can we trade futures on this? And yes, one of the things that we do with futures would be the NASDAQ futures or the S&P futures. And I would prefer to do things like a strip or strap straddle. It's still all long calls and or long puts. But remember, on a futures contract, you're in a margin account anyway. But let's say we were doing an event that was happening at 10 and we had access to the QQQ or the SPY. Let's say we had that. At that point, you could look to place, in this case, if I'm looking to be short, I could place a trigger to be long two puts of the SPY and long one call, 2 puts to 1 call. It's a 2-to-1 ratio. Sometimes I'll do 3-to-1 if I'm feeling a little bit more directionally confident. I'm not directionally confident today, right? For many, many reasons. So my position is conservative. My position size is small, right? And I've had now, maybe I should have given the ES a little bit more time, but you know, could it go to 52.80? I would anticipate it can, but at this point, I can sip some coffee, I can take a breath, and I know no matter what, if I snap back up to 1 point beyond my entry on the ES, and how many points above the NQ, I'll go to about 2, maybe 3 points above the NQ. So it's about $60, $40 to $60 per contract. And if on that continuing digestion of the data, we move up higher, I'm only risking unrealized profit. It's monopoly money. Please do not look at your P&L right now and go, that's my money. Please don't do that. That's not our money. It's not ours until we close the position. So a lot of times this high water mark becomes a trap, because as price got down to 52.88, you know, the P&L shows this much money, and then as it bounces, it goes away, and traders say, well, when I get back down to that P&L again, I'll get out, or, you know, I'm losing money now. We're not losing anything, right? We've already realized the profit and or moved to break even. We've taken the risk as best we can off the table. And now I wait. There's no re-entry after 180 seconds, right? So 8:30 to basically 8:33 is my window for entry. And like I said, I don't like how it's been so slow, because the ideal scenarios are we wick up and then we start to retreat right away to that halfway point. That's what the PSC is. And you'll see we're nowhere near that previous session close, right, on the ES. As much as I'd like that to be the level, we may never get down there. So it moved up dramatically. Gang, that was a 30-point move on the ES, which is a large move for the S&P futures. On the NAS, as you can see here, that was a 140-point move. Yeah, 140, almost 148 points. That's significant for the NQ. So we are really far away from the previous session close. Again, I'm not getting that snapback, and I'm going to start to at least pay myself. So if nothing else, as we wrap this bonus session up, I know that I've taken profit on, you know, again, if you want to go with a third of your position, half of your position, don't go more than half, and realize that profit. Yes, it was a small profit, but it's mine now, and it grew my account. That's all that matters. Now with the break even, this house money, this unrealized profit, it's not mine. Please do not attach to your P&L, only your realized P&L, not your unrealized. That's monopoly money, your realized. If we continue to move lower, great. If we don't, I've done what I'm supposed to do. I'm supposed to pay myself while I can, not when I have to, and I manage my risk. And that first target, whether that be optional or in this case that PSC, its job is to start the risk management process. And that's your PCE. And that's how I trade really any high impact event using the hourly price movement ranges. That's it, gang. Not bad. Not bad. You know, I'm starting off when the bell rings later on this morning. Oh, by the way, so the last bit is, as we get closer to the bell, I really do want to either just close the trade out. It's only 8:45. So by 9:15, if this thing in 30 minutes is not continuing to work in my favor, you know, we already have the break-even stop. If by around 9:30 you want to take another half off, if you want to take another third off, if we're continuing lower but not quite to the previous session close, that's perfectly fine. I really don't want to be in any major risk event without some sort of tightened stop to capture, to hold my unrealized profit. I don't want to be there at 9:30. I want to make sure that I've got some sort of tighter stop there, because we know the reaction at 9:30 is going to be another burst of volatility. But that's it. Did our job, manage risk, took a couple points along the way. That's your PCE. Now, last bit, the macro impact. Okay, so again, notice I have not once looked at the data, because that's really probably the least important conversation. September, are expectations any different for September rate cuts. Well, if you watched any of the sessions we did yesterday, you know that we were hovering 46, 48%, I believe. So we're a little bit higher in terms of September rate cuts at 51.7%. Are November expectations a little bit higher? Indeed, they are. These are slightly, and I do mean by a handful of percentage points, these are a handful more leaning towards a rate cut in September and potentially a second one in November or December. What about July or June? The expectations for a July rate cut went up a little bit, but it's nowhere near the probability, which is still a 65% expectation for a hold. And June continues to be a hold. So June's a hold, very much probabilistically. July is a hold. September is where the first rate cuts are at least on the table. So we are looking at 1 to 2 rate cuts by the time we get to that December 18 meeting, based on what we know today, May 15, after the CPI, which is the second most important inflation metric that we look at to understand what the Fed may or may not do. All right, gang, that's a wrap. Hope that was helpful in terms of understanding how we can capitalize on these, as well as the macro implications of data like this.